Because I think like when an angel side or a pre-seed investment, like, listen, you're probably trying to raise like, you know, uh 250 to 500,000 initially to get your idea off the ground, to go from there. When you're coming to a venture fund like Unicorn, you're raising in the millions.
Mhm.
More so, and then you have something where you have some sort of product market fit. You know where you want to put the money, whether it's in technology or hiring the right team members to get to more scale,
Mhm.
right? Like really, you're just trying to prove out that you, for the first $500,000, that you have an idea that makes sense, that there is some traction, and then from that traction you could raise more money to get to revenue.
All right, everybody, welcome back to the Richer Geek Podcast. Today, we welcome Jonathan Hung. How you doing, Jonathan?
I'm doing great, thank you, Michael.
John or Jonathan? What can we?
Either or. I've
Either
answered
or.
to both in a professional setting. If we go drinking, then you know me as Johnny.
There you go. Well, I'm not sure people would call me Mikey without a sneer, but
Right.
it's the same with me, Mike or Michael. But so Jonathan, you are an angel investor, a venture
Mhm.
capital partner,
Yep.
and to set the tone, ladies and gentlemen, I'm not sure that there's a place that's like the places to graduate that Jonathan hasn't graduated from. I mean, get this. Okay, several degrees from the University of SoCal, London School of Economics, Massachusetts Institute of Technology, MIT, and one of the big ones, the Wharton School at the University of Pennsylvania, one of the best schools there is. Wow, you just like to go to school, huh?
It's so funny you bring that up, and I kind of messed it up. I was just trying to go for 3-letter acronyms, right? USC, LSE, and MIT. That UPenn screwed it up.
There you go.
So I would ask me like, oh, like, some of my dad's friends, like, man, you sure love school. And I'm like, well, listen, if I was going to be a lawyer, I got to go to law school. If I want to be a doctor, got to go to, med school. And like, there's no one way of being a venture capitalist. Either like, listen, you got money or you don't, or you got to work yourself up, right? And like, just because you have money doesn't mean you're a good venture capitalist. Just means you got a couple extra bullets to shoot your shot. And for me, it's like, each of those institutions or each of those places I went to, it helped me get better as an investor, because I know that I'm not the smartest guy in the room, but I know where they are. And I like to make sure that, this is the room I want to be in. I mean, if like I'm the smartest guy in the room, I got to get the hell out of that room.
Yep.
Because it's not enough. I need other people who are better at, due diligence or financial modeling or like product development or marketing to help get me, whether it's a consumer product or an enterprise product or a SaaS play, to the finish line, whether that's an exit or, an IPO.
Yeah. So let's start. How did you get involved? A little bit about your background. How did you get involved in the angel investing?
Sure. For me, it started back in 2012. I came back home to run my family's clothing contract manufacturing business called Barrage, United Overseas Textile Corporation. So within that company, I was able to do everything from importing and exporting of clothing made in China, whether to some of our customers like Amazon, Costco, Bruin & Co. factory. So it was a great learning experience. For me, it was my father's company, and I was able to help. Unfortunately, he got sick at the time, so I had to help him and take over the business. But at the same time, before then, I was a financial advisor, and so I was able to trade public equity, stocks and bonds, etc. And I was just so curious about just investing as a venture capitalist or like really early stage. And so, I heard something about Silicon Beach. I'm from Los Angeles, and I said, let me go dig in. And, for better or for worse, like my first investment I ever made was a company called GIFT, GYFT, and that exited in 10 months. That's really pretty good. 2.5x multiple in 10 months. I'm like, oh, this is easy. But it's not that easy. And I've lost a lot more money, but I made more along the way. And it's been a great adventure since then.
Yeah. Fantastic. So, let's dig into, let's explain to our listeners exactly what some of this stuff is. We've talked about venture partnerships, angel investing. There might be some of our listeners that are thinking about, hey, I always wanted to start this or get into my own business.
Right.
And in some situations, you can do a syndication, you can do a fund, you can do these types of things. But angel investing, I've heard some things about, I've had some angel investing, some funds and venture partners come and want to do some hotels with me.
Right.
And, I've been hesitant because maybe I didn't quite know exactly what it was I was getting into. How much power they would want, how much control. So tell me a little bit about angel investing.
Well, for me, angel investing is totally different than being a venture capitalist, right? Like, I would say it requires a different type of skill set because, for running a venture fund, you have to be good at raising money from other people, right? It's called OPM, other people's money. And of course, you put like a little bit of your commitment into it, but really it's a process. And there's investment memos you need to write, diligence packages you need to make. Like, it's a 3-year cycle of investing, and you have to make sure that these are the best things that you can invest in this 3-year time period. Whereas angel investing, I think it's so much more relaxed, and it's your expertise, what you like to do. It's your money. You get to make the decision. You don't have to talk to anybody else. You make the call. Perfect example. I had a company called Bear Flag Robotics, and it got bought actually 13 days ago. Today's the 17th, so it got bought August 4th. And so because of one of those schools I went to, Wharton, I got to meet a guy, Gino Caffiero, and he had an idea about automation when it comes to farming and tractors. And, he was raising at a $3.5 million valuation. I knew him from business school. I knew his character. I knew where his family, his background was. He worked at Cisco. Funny enough, we were just talking about, that company. And really, he had nothing at the time. You just knew you had to believe in him as a person. You believe him as an individual. Because like, if it was for a venture fund, there's no way you would have put money in at that time, because he didn't have product market fit. He didn't have an MVP set up. He didn't have wasn't a roboticist. He went to Carnegie Mellon and Wharton, but that didn't mean that he was qualified to understand what farming was or what automation was. But if you knew him as an individual, like that's the bet I made on him. So I wrote a $25,000 check as an angel, right? So angel investors, like you can write a $25,000, $10,000, all the way up to $100,000 check. Where a venture capital, you're writing a little bigger. Like, my venture checks are anywhere from 50 at the really low end to up to $1 million. So that takes a lot more diligence. An angel investor, you're taking more chances, at a higher risk, but higher reward. So funny enough, Bear Flag Robotics, got bought like 13 days ago by John Deere, for $250 million. So I got in at 3.5, pretty decent, right? But a venture VC would not have done it. Maybe they would have done it like when Gino did his seed and his Series A, when you had something definitely more product market fit, more customers, more tech, and a bigger team than just himself. But angel investing to me is always about, well, it's my money and you're willing to take a chance really super early versus like, where a fund, you just have to have really true conviction of why you made that investment at that given point in time.
Yeah. And, for someone that's looking at, approaching either venture partners, syndicators, or angel investing, the paperwork, you also have to look at.
Oh yeah.
Looking for an angel investor is a lot cheaper than spending $25,000, $30,000, $35,000 on the attorneys to draw up all the paperwork for your VP or limited partnership, your syndication, or whatever it is. So it's probably a lot easier for people to ask for angel investors.
Yeah, definitely. So it is so much easier, than going through a fund itself, and like, and also like, but I don't mind paying fees, like if we're all making money together, I don't mind paying for other people, because it's just, you got to make money. You got to spend money to make money. That's how I always viewed it as. I made an investment recently where I got into SpaceX, and I'm paying a pretty hefty carrying cost of 25%. And you know what? But I couldn't get in the deal any other way. And if you're a big believer in space, not just going to the moon, but like, SpaceX is space transportation, and this is going to be the Ford for space, hey, this is going to be a company that's going to be around for a very long time. So even though it's illiquid, you don't know what Elon's gonna, do. It's really up to Elon. But if you believe in that sector, you make that bet and you just set it and forget it.
How can people find angel investors?
It's really like, I would say angel investors, you don't just like wake up one day like, hey, I'm a doctor, I'm a lawyer, I work at Google or Facebook and I have all this extra money. I see like you find syndicate groups, like I'm a member of Tech Coast Angels, right? And really like my mistake and my luck in the beginning was like, yeah, I made great money on my first investment, but that was just pure luck and chance. I didn't have a process, didn't have the right people, because, the fifth investment I ever saw, because I always remember it because I turned it down. It was a gaming company where you pretend to buy and sell stock and you get a score every week. And I was like, who's going to play this game? And I didn't understand, like, why is it worth $20 million? It seems a little pricey. I didn't know enough people, but I got sent to it from a friend of mine who worked at Goldman Sachs. He was a managing director there. And it just didn't seem like it was like Plants vs. Zombies, or, it wasn't where's the pigs and the birds, right? Where were the angry birds? I don't get it. Like, how are you going to come back? And I wish I knew that they were selling the data. They were selling the data from the free trades that you were making, because you didn't actually buy anything. What you got was it was just pretending to buy and sell stock. And I was thinking, why is this company called Robinhood? And I turned down Robinhood at $20 million valuation. And it wasn't that my deal flow was there. I knew plenty of people, right? But I wish I had a network. And that's what I started doing, building since 2012, my network of, being an LP in over 25 different funds, or, working with all these great people, and having really, like, once you have great entrepreneurs, you go to them and talk to them about it. I wish I had that then. I wish I had the partners now that I did then, because maybe I would have wrote that check, that 25,000, and it'd probably be worth like 30, 40 million now. Because, if you look at Robinhood, just went public a couple of weeks ago at, it's at 30, 40 billion right now in market cap. But you know what, you do this long enough, hey, you're going to have those. You're going to have an anti-portfolio, and that's okay, because you have to find the right group, whether it's like an alumni ventures group, or you work with other people who went to school with, or, these angel networks within your own city. You're going to find people who are like-minded in the sense that, you want to help strive to a goal together, because I'm going to ask different diligence questions than someone else. And I was like, wow, I didn't even think of it like that. And now, like, I've basically stolen bits and pieces of what I'm telling you right now from other people.
Yeah. What are some of the due diligence questions that you would ask? If I'm sure there's a lot of our listeners right now thinking, wow, okay, I've got an extra 25, 50,000. Maybe I want to do this, but they've never done it. So what are some of the questions people should be asking? Because here, there's a lot of ideas that sound great.
Yep.
Right. But they may be just smoke and mirrors.
Yeah. I look at four key things when I look at a company, whether I want to continue diligence further and bring in other people. Number one for me is the team. I mean, it's so important looking at who the team is, whether they have experience in that sector, or they have the right educational background, or, they just have the right network of people to help them. It really is so important when it's early stage investing. Because, like, when I look at investments, anything under 20 million to me is Series A and under. Right. It's Series A and above, Series B and above. You know what? Those are more professional. Those are more like, those are like hedge fund managers, private equity people, growth investors. And it's different because they have product market fit. You're basically adding fuel to the fire. But when it's really truly early, I got to look at the team first, because it's not about the idea. I mean, I turned out Robinhood, and I shouldn't have turned out Robinhood because I thought the idea wasn't great, but the team, look at the two guys who are still running it to this day. They're still there. That means they have true grit, that they're relentless. So you got to look at them, because listen, I just remember they had something that failed initially, but they were still working and figured it out. That's so important. Like, it's never always someone who just like, oh, hey, they're Mark Zuckerberg and they figured it out the first time around. And you just really need to see the team and who they are. Number two, I look at the idea, right? I mean, you look at, is it something where it's like, hey, is it some sort of code that makes sense that I don't know about? They're changing the game, whether it's an enterprise play or a direct consumer play. Is there something different that you don't see in the marketplace? Like, just like we talked about Bear Flag Robotics, like, it makes sense. Automatic, tractors, that makes sense. People don't want to farm, don't want to be in the sun. Look, I'm a little sunburned, you can't see, but I am right now. Like, yeah, why would I be out there all day? it makes perfect sense. But it doesn't mean that they can't do it. Like one of my like investments I made early on was also a company called Miso Robotics, and literally like Miso is raising a $350 a million valuation now, but at the time it was just four roboticists from Caltech saying we want to make a robot that makes hamburgers. That's it. That's it. That was the pitch. And I'm like, okay, let's look into that more. So it was the idea that I focused on because it made sense. Like, no one's dream is to work at McDonald's for 20 plus years. That makes no sense. It's a good first time job, but it's not like the last job you're ever going to do. So maybe we can make that more efficient, more better. And Miso has done a tremendous job since, coming in from a concept into actually having the robots to do it. Then 3 and 4 are kind of interrelated. You look at the revenue growth and the customer growth. Because sometimes a company could have so many users, but they're not making any money, which is totally fine. Because look at LinkedIn. LinkedIn grew every year over year for a tremendous amount of time when Reid Hoffman started, but they weren't making money. Like it was free to sign up. But just like, wow, the potential of it growing to so much because scaling is so quick. People ask you, what's your daily active users or your monthly active users? Because the question is, there's going to be people who are going to churn. But if you have such a huge data pool of people, like you're going to find a way to figure out some way of monetizing. And then you look at revenue at the same time as 3 and 4, revenue growth and customer growth. Revenue growth to me doesn't mean like you're making $1 million monthly recurring revenue. It's really you're growing week to week, day to day, and you see that trajectory where you're going to get to that hockey stick and then take off. Like because when you're really early, you're not going to get into the millions and millions. I sometimes see projections. I'm like, I don't care about your 5-year projections or your 3 or 4 year because they make no sense. You're going to be pivoting. Like I just want to see how you get from 0 to 100,000. And then from 100,000 to 1 million, and from 1 million to 10 million, because that's the trajectory I'm going to see that makes sense. That like, oh, that's how you grow. That you're actually coming with a business model that makes sense. So that's what I would always look for. Those 4 criteria when evaluating a company from the start.
Yeah, it's great information. I'm taking notes also because I've put some money into some startups and things like that, and it was people that I knew. And they had successful companies, so I knew that was a pretty good chance for it, to be successful. But when you don't know the person, those types of questions are really strategic. Now, let's talk a little bit about the venture partner side. You're a co-managing partner at Unicorn Venture Partners.
Yes.
And senior venture partner. Now, if I get this right, Unicorn, no, that was Expert Dojo's the international. Unicorn is U.S. based, or is it just, what is Unicorn?
So Unicorn is basically a pre-seed, seed, and Series A venture fund that 3 partners came together, 3 family offices. We don't have outside capital, so it's only our own money that we're investing in. We try, so it makes it a little easier in terms of like, making decisions. And we don't have to be like, oh, we have to do this in a certain amount of time, and we have to worry about raising the next money. So for us, we don't have necessarily a geographic location that we focus on, but most of our companies are US based. We will look outside the US, but it really just depends how safe and how strong we feel the company is in another jurisdiction. Most of our investments are here, either in LA or Silicon Valley or even Texas. But the difference for us is that with something like Expert Dojo, it's really we're an accelerator, we're an international accelerator. So I've been on calls where we look in Egypt, or we talk to somebody in India, or someone in Nigeria or Sweden. It's like we're trying to find the best companies around the world because we're taking really truly early bets at a really low valuation to make that they can be something amazingly great, and help them build to that point where then a unicorn can come in and invest. Like Unicorn Venture Partners is not going to invest in a company that Expert Dojo does, even though we have done that at the same time, but it's very rare because it just needs more time for a company to get mature enough to get the seed money that they need to grow.
So, with Unicorn, if someone had an idea or they have some investors and they need that next second series or that second raise, to truly grow. They're stagnant, and they've gotten to the point where everything's going, but they really need that extra 5 million, that little push. Would they be looking more of an angel side or a venture side?
Honestly, it would probably be more for an angel side, because I think like when an angel side or a pre-seed investment, like, listen, you're probably trying to raise like, you know, uh 250 to 500,000 initially to get your idea off the ground, to go from there. When you're coming to a venture fund like Unicorn, you're raising in the millions.
Mm-hmm.
More so, and then you have something where you have some sort of product market fit, where you want to put the money, whether it's in technology or hiring the right team members to get to more scale, right? Like, really, you're just trying to prove out that for the first $500,000, that you have an idea that makes sense, that there is some traction, and then from that traction you could raise more money to get to revenue.
Okay, yeah, that makes sense. It's there's just all this different ways of doing things, and now there's all this crowdfunding, crowd sharing, and when someone is starting out, it's what do I do, how do I do it? And I always talk about the team. You always need a mentor. You need someone, so you don't make the mistakes that we did when we first started out. And it's fascinating. Now, when you talk about fundraising, talk to me a little bit about how you concentrate or even help people when you find a company. What do you talk to them about? Hey, this is the way we're going to do some fundraising, or these are the things that you need, that I have a company. These are the questions that I better have in order to talk to Jonathan Hung. So that I don't get turned down.
Yeah, definitely so. Because listen, like, nobody writes the entire round. Like, nobody funds everything. You want to find great partners, angel investors or other funds. So for me as a fund, listen, I get pitched a lot from other funds that I'm an LP in, or just I've co-invested with. And because, you're either writing $500,000 to $1 million, but that's leading for a series seed round. So there are opportunities to bring in extra help, or maybe like, hey, we're better at consumers products, right? And so we should come in and help with our expertise and our network of not just money, but network of influencers, network of marketing people, network of distributors that can help a company. Like, I think that's so much more important than just, I'm trying to get as much of the round as I can. Like, it really is, for me, it's like the pizza problem. And you see that with what Elon Musk did with his superchargers. It's like, now it's like, you don't just have to have the Tesla to go use a Tesla supercharger. Anybody with, an electric vehicle can use it now. And that's great, because you want to grow the pie bigger, not just like cut off a portion of the pizza for yourself. You want to make the pie bigger so that eventually whatever share of the market you own, it's just going to be bigger because everyone's involved.
Yeah. And the only bad thing about that is when I go to a supercharger bank, they're busier now. And I think they're going to get even busier when other type of cars are coming. So I think he needs to build some more supercharging banks, so that now I wanted to ask you a question about the within your angel investing or your fund. You can talk about either one. What kind of control do you have, or do you take like a board member, or what kind of control do you have if you say you give a company $1 million? Are you just passive?
Usually we're not, right? Because it's for us, it's a core. If we're writing $1 million check, it's a core investment for us. So, and we're leading the term sheets, right? So on the term sheet, depending what we're looking for, whether the investment vehicle is, we're looking to take a board seat, right? We want to be involved, but it's not like I want like 20 board seats, because I only have so much time in the day as well. But you're basically guiding and helping a company out. Like, I usually like to take in the beginning, whether it's a pre-seed or seed company, I like to take, annual monthly calls, and check in, and then get to quarterly calls, right, for the board meetings, and make sure that you're on track, you're on pace. Because listen, if you're a venture fund that has outside money and limited partners, listen, that's important because you can't be passive. Like if one of my LPs, if I raise a fund, asks me like, well, how's that investment doing? And I have no idea, that makes me look bad. I mean, I need to know what the problem is for a company before we even get to the board meeting. That's the most important thing. Because I tell people, like, I'm supposed to be your case of emergency contact. When you fill out that form at the doctor's office, who are you putting down? Hopefully it's your significant other or, a close family relative, right? But when it comes to business, like, I have to be that person for you, because it's not because I own a lot of the business. It's more because, like, hey, I've been through this before, and I can tell you how we can make changes that make sense before issues come up or get bigger.
Yeah. Do you get any pushback from, because some of these entrepreneurs, this is their baby, and they're like, well, wait a minute, Jonathan, what do you know about robotics and things like that? And now you want to, you get pushback?
You do. Of course you do. But you know what? The idea is that not all money is good money at the same time. Like, listen, like, if we got to a stage where I'm your lead investor, it's like, it's not because you just took it just because of money. Right, because you like who I am and how we work together. So it wouldn't be that big of an issue, because for me, my job is once I always tell this analogy, like, my job is to get you through high school, like to get to your Series A, and then from there on you're off to college, and that's another set of professors, right? Another set of advisors to get you through, and hopefully you graduate, and like you IPO or get bought, which is great. So for me, it's like I take it's good to be able to take criticism as much as you take praise. And that's so important, because listen, I'm not investing to be your best friend. I'm investing to help you get to the next stage. Like, it's not like when you have coaches, like, it's like, oh, they just give you all this praise and you never improve. Like, you have to point out what the weaknesses is and where we can improve to get to the next goal. I mean, that's just so much more, because why hire a coach? You don't just hire a coach to like tell you you're great and you don't get drafted.
That's right. Yeah. That's very good. I always wondered with the angel investing in the funds, I had one, they're wanting me to buy, for instance, 3 hotels. They wanted me to manage it, me to do all the work. And then, they're going to put in, 80%, me 20%, but then they are in turn only going to give me a certain percentage of the profits.
Right.
And I was like, so is that kind of how it works, or do you just let it ride, or do you sit there and say, hey, look, it's almost like Shark Tank, right? For X amount of money, we'll buy in this percentage of the company. And then, but in return, we only give you X amount because we're basically going to take control.
Well, no, I always Shark Tank's a great show. I love that show. I've actually had companies that I've invested in been on the show, and they turned down the deal, right? It's actually sometimes it's great exposure. And a lot of times you don't even like, they agree on the show for TV, but it's not reality. It's not actual deal. It's like, I always think, gee, I wish I could get a Shark Tank deal, get like half the company for like $250K. Like, geez, because it's really not that great of a company if it's really that low in valuation. I could get half the company for under like $1 million. But from my perspective, it's, you have to be fair. You understand where we are in the marketplace. Like, look, certain deals you get out of Silicon Valley, they're going to have a Silicon Valley like halo effect and a pricing towards it. And it's other people competing for the deal. LA, New York, other secondary or tertiary markets. Listen, you're going to get a better, valuation than you would in Silicon Valley. But once again, it's about the team. Like, if it's such a solid team, like, what's the difference between investing at 5 million versus 10 million? Because you're going to get to that goal of like, $100 million company or $1 billion company. So that's not the big issue. The issue where it comes to effect was like, you're just not certain, and you're not certain if this is the right team to get you through there. So that's why you ask for a lower valuation, because nothing's proven out. Like, listen, if Elon Musk wants to raise money for next company, he's going to get whatever valuation he wants. Right? Because he's proven, he's been there, he's done it before, and time and again. But if you're just somebody who's just starting out, listen, you're going to have to come a little lower, and especially if there's a lot of competitors in your space, whether it's like, especially when it comes to CPG and consumer goods, you have to look at the comps.
Mhm.
Because if I start like a candy company with zero sugar, or another soda company with zero sugar, or whatever, like, listen, there's a lot of people in that field. Like, you're gonna have to raise a lot more money than you
Yeah.
can to compete with Coca-Cola and Pepsi, who are, the mainstays right now. So it really just depends on each situation. But like, I don't get like shocked right away, because listen, it's a learning experience too. First time entrepreneurs, they're going to learn too. Like, sometimes when I'm working with someone who's like, failed or had successes, they understand how it works and they're more reasonable to negotiate out. And sometimes, listen, you can't agree on every single deal. And that's why, what's great is that you work it out. If it doesn't work out, that's okay. And
Mhm.
sometimes I tell people this really importantly: I never just say no to anybody, because that makes no sense. Like I said no to SpaceX, for example, when it was at like 60 billion valuation, because I just didn't see it. Now, like, I got in at around 90 billion valuation, and I'm thinking, well, I get it now. I see it now. Starlink, I see it. Just like in the stock market, just because you didn't invest in Apple at 150 or $100 doesn't mean you can't get in at 120, because now it's at 150. Like, there's still times you can still get back into a market where you makes sense. It's like, I'm just passing at the current numbers and what I
Mhm.
believe are the right, where my comfortability is. Like, it doesn't mean I can't come back in later on and write a check.
Yeah. And, I see in part of your portfolio how you're taking some risks where there are some bigger names, for instance, like ChowNow.
Yes.
Um, you know, to me, just kind of looking at this,
Yeah.
we're just talking, it's like, wow, there's some big dogs out there.
Yep.
What made you want to invest in something like ChowNow?
It was the funniest thing. Like, talking about like full circle, or how we started this podcast. Now, we're not doing
Mhm.
listen, it's unscripted, everyone. Michael is not setting me up, but like, so I talked about that first company I made, Gift, right? GYFT,
Yep.
mobile gift cards. That was the idea, cloud. And this is before Apple Pay, Samsung Pay, whatever. Like, before Gift came out, it was just like the physical gift card space was 95% of the market. You actually had to have the gift card
Mhm.
in order to use it. Now it's like you could just send gift cards, right? Or send money in the cloud, and it's just stored in your, it's like, so if you lose the card, you just lose the card. That's totally fine.
Yeah.
Like Starbucks, you just use your mobile phone to pay, right? So I exited that company to First Data in 10 months, and I had like 2.5 multiple, and I'm like, well, I don't want to pay short-term capital gains tax, so I had to roll it over into a company. So I looked at the bet, what was available, and I was presented with ChowNow. I believe they're raising at a $40 million valuation at the time, and I saw their deck, and I remembered something so interesting from it. There was a quote from Patrick Doyle, who was at the time the CEO of Domino's Pizza. And just looking at it, it was just saying like how mom and pop restaurants couldn't compete against a McDonald's or a Domino's, even though, like, you have a great like Italian restaurant who makes great pizza, and you're so much better tasting than a
Mhm.
Domino's. Domino's kills you on pricing and kills you
Mhm.
on your tech, because you can order online. I mean, Domino's doesn't even own their franchisees, right? It's all franchised out, and so it's a huge supply chain of getting the dough, the ingredients, the marinara sauce out there. So it's like, for them, they were saying, listen, our online mobile ordering is so much better than any other local markets. Like, we're going to kill it that way. These mom and pops have no chance. Here comes ChowNow saying, well, we're going to help mom and pop restaurants out. We're going to get them to the 21st century and put their menus online, for them to have an
Mhm.
ordering platform. Because, like, listen, if you're, a couple of pizza chains, doesn't mean you have the money to spend in the tech. It's
Right.
probably more into marketing. But here's a company for software as a service. You pay us. Hey, we'll get you your menu online, and you can find more people that way to order. And that made perfect sense to me. And I invested my entire amount from Gift into that.
Mhm.
And so it's worked out. Right now, I can't disclose the numbers, but definitely ChowNow is definitely worth more than 40 million when we put in. And it's a great success story, because it said something where it's just like, listen, most of the companies aren't about just enterprise. You're not just going against Walmart all the time.
Mhm.
America and most of the world is built on small and medium enterprises. And if you can find a way to help them improve their business margins, they're going to use your software.
Mhm.
And there's just more clients versus where, you got to get, the Fortune 500 to install your app. No, you don't. Of
Yeah. Well, it's been fascinating, Jonathan. We appreciate you coming on.
course.
How can people find you if they have any other questions? If they want to kind of like follow how you're doing some things, can people reach you on social
Sure.
media?
Sure. My website is jonathanhung.com. You can send in emails there or just connect with me on LinkedIn. It's Jonathan Hung. Yeah, those are the best ways
Yeah.
finding me. And I do a lot of video podcasts and blogs. And if anybody wants some free advice, hey, come take a look.
Well, I'm sure there's a lot of people that will love this episode and definitely take you up on that. So thank you, sir. I appreciate everything you've done, and thanks for coming on.
Thank you, Michael. It was a pleasure.